Benjamin Graham wasn't just an investor, he was a financial revolutionary. His ideas and methods have left an indelible mark on the world of finance, influencing countless investors and shaping the way we think about the stock market today. Born in the late 1800s, he lived through periods of incredible market booms and devastating busts. These experiences provided him with a unique perspective on the volatility and unpredictability of the financial markets. This experience shaped his investment philosophy, one focused on logic, discipline, and long-term value. Graham believed that by adhering to a set of core principles, investors could navigate the turbulent waters of the stock market with greater confidence and success. He penned two seminal works, Security Analysis and The Intelligent Investor, forever changing how people approach investing. These books laid the foundation for what would become known as value investing, a strategy that emphasizes the importance of intrinsic value and margin of safety. Graham wasn't interested in get-rich-quick schemes. He understood that true wealth was built over time through careful analysis and prudent decision-making. He championed a more grounded approach to value investing. This method required patience, discipline, and a keen eye for identifying undervalued opportunities in the market. His core belief? Buy stocks when they are undervalued compared to their intrinsic worth. This approach not only minimized risk, but also maximized potential returns over the long term. Think of it like buying a designer dress on sale. The value of the dress remains the same, but the price you pay is significantly lower, providing you with a bargain. The dress is worth the same, even if the price tag is temporarily lower. This analogy perfectly encapsulates Graham's philosophy of seeking value in the stock market. Graham's principles resonated with countless investors, turning him into a legend. His teachings provided a roadmap for those looking to build wealth through intelligent investing. He wasn't just teaching people how to make money, he was teaching them how to think about money. His emphasis on critical thinking and thorough analysis set him apart from other financial gurus of his time. His influence is still felt today, with his disciples becoming some of the most successful investors of our time. Figures like Warren Buffett, who studied under Graham, have carried forward his legacy, proving that his principles are timeless and universally applicable. Value investing, at its heart, is simple. Don't be fooled by its simplicity, though. It requires patience, discipline, and a willingness to think differently than the crowd. Graham believed in thoroughly researching companies, digging deep into their financial statements, and understanding their true value. He urged investors to ignore the market noise, the daily ups and downs that can spook even the most seasoned investor. Instead, he advocated for focusing on the fundamentals. What are the company's earnings? How much debt does it have? What is its competitive advantage? These are the questions that matter. By understanding these core elements, investors could identify undervalued companies poised for growth. This wasn't about chasing the latest hot stock tip. It was about making calculated, informed decisions based on solid research and a long-term perspective. One of Graham's most enduring concepts is Mr. Market. This metaphorical figure represents the stock market's emotional and often irrational behavior. Imagine Mr. Market as an emotional fellow, prone to wild mood swings. He is not a rational being, but rather a personification of the market's volatility. Some days he's euphoric, willing to pay top dollar for even the most dubious investments. On these days, the market is driven by greed and optimism, pushing prices to unsustainable highs. Other days, he's despondent, selling valuable assets for pennies on the dollar. During these times, fear and pessimism dominate, causing prices to plummet. The intelligent investor, Graham argued, shouldn't be swayed by Mr. Market's whims. Instead of reacting emotionally, they should remain calm and rational. Instead, they should recognize these fluctuations as opportunities. When the market is irrational, it presents chances to buy low and sell high. When Mr. Market is fearful, that's the time to buy. Fear often leads to undervaluation, providing a chance to acquire assets at a discount. When he's greedy, it might be time to sell. Greed inflates prices, creating an opportunity to sell at a premium. This leads us to another crucial concept, the margin of safety. This principle is about buying securities at a significant discount to their intrinsic value. Graham stressed the importance of buying stocks below their intrinsic value, providing a cushion against potential losses. This discount acts as a safety net. This margin of safety acts as a buffer, protecting investors from market volatility and unforeseen circumstances. It ensures that even if the market turns against you, your losses are minimized. Remember, even the most thorough analysis can be wrong. No one can predict the market with absolute certainty, and mistakes are inevitable. The margin of safety is your insurance policy in the uncertain world of investing. It provides peace of mind, knowing that you have a buffer against potential errors and market downturns. By adhering to these principles, you can navigate the market's ups and downs with confidence. The key is to remain disciplined and patient, always looking for opportunities to buy undervalued assets and sell overvalued ones. In the long run, this approach can lead to substantial gains and financial stability. Remember, investing is not about quick wins, but about building wealth over time through informed and strategic decisions. So, take a page from Graham's book and let Mr. Market's erratic behavior work in your favor. Embrace the margin of safety, and you'll be well on your way to becoming an intelligent investor. Section 4. Separating speculation from investment. Graham drew a clear distinction between investing and speculation. Investing, he argued, involves thorough analysis, aims for safety of principle, and seeks to generate satisfactory returns. Speculation, on the other hand, is often driven by emotion, relies on short-term market movements, and involves a significant risk of losing capital. He didn't condemn speculation entirely. He recognized that it had its place, but he urged investors to understand the difference. Don't mistake luck for skill. Just because a speculative bet pays off once doesn't make it a sound investment strategy. The intelligent investor focuses on the long game, building wealth gradually through disciplined research and a commitment to value. They understand that true investing is about participating in the growth of successful businesses, not trying to time the market or chase the latest fads. Section 5. Warren and Peter, students of Graham. In the world of investing, few names resonate as profoundly as Benjamin Graham. His teachings have shaped the strategies and philosophies of countless investors, but none more so than Warren Buffett and Peter Lynch. Benjamin Graham's teachings had a profound impact on generations of investors. His principles of value investing, which emphasize buying undervalued stocks with strong fundamentals, have stood the test of time. Graham's approach was methodical, focusing on the intrinsic value of companies rather than market speculation. Two of his most famous disciples, Warren Buffett and Peter Lynch, went on to achieve legendary status in the investment world. Their careers are a testament to the power of Graham's teachings. Both men took Graham's principles and adapted them to their unique styles, achieving unparalleled success. Buffett, often called the Oracle of Omaha, credits Graham as his most significant influence. He has often spoken about how Graham's book, The Intelligent Investor, changed his life. Buffett's approach to investing is deeply rooted in Graham's philosophy, but he has also added his own insights, focusing on the quality of the businesses he invests in. He adopted and refined Graham's value investing principles, building Berkshire Hathaway into a multinational conglomerate. Under Buffett's leadership, Berkshire Hathaway has grown from a struggling textile company into one of the largest and most successful conglomerates in the world, with holdings in diverse industries such as insurance, utilities, and consumer goods. Lynch, known for his tenure at Fidelity Magellan Fund, employed a similar approach, focusing on identifying undervalued companies with strong growth potential. Lynch's strategy was to buy what you know, encouraging investors to look for investment opportunities in their everyday lives. This approach allowed him to identify promising companies before they became widely recognized. He emphasized understanding the businesses he invested in, often drawing insights from everyday observations. Lynch believed that individual investors could outperform professional fund managers by leveraging their unique insights and experiences. His success at Fidelity Magellan Fund, where he achieved an average annual return of 29% over 13 years, is a testament to the effectiveness of his approach. Both Buffett and Lynch serve as testaments to the enduring power of Graham's teachings. Their success stories inspire countless investors to this day, proving that Graham's principles are not just historical artifacts, but living, breathing strategies that can lead to financial success. They demonstrate that while markets change, the fundamental principles of value investing remain relevant. In a world where market trends and economic conditions are constantly shifting, the core tenets of value investing, discipline, patience, and a focus on intrinsic value, continue to provide a reliable roadmap for investors. They prove that success in investing comes from discipline, patience, and a commitment to uncovering value where others see none. By adhering to these principles, Buffett and Lynch have shown that it is possible to achieve extraordinary returns and build lasting wealth, even in the face of market volatility and uncertainty.